Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq, coming to you live from Exchange in Miami. Joining me for this segment, we have Jason Bloom, head of fixed income and alternatives ETF product strategy at Invesco. We're here to discuss a suite of products that minimizes fixed income investment risk and adds efficiency relative to individual bonds. It is great to see you as always, Jason. Welcome back to TradeTalks.
Thanks for having me back.
With the volatility in the broader interest rate over the past 2 years, and the Fed now pricing in rate cuts possibly starting this spring, how have you seen investors utilize bullet shares to strategically allocate considering the possible shift in Fed strategy?
Right. It's kind of a yield curve shape in an interest rate environment that we haven't seen really anything like this in over 20 years. And when you have a steeply inverted yield curve, you're getting these very high yields at the front of the curve, relative to the yields further out the curve. And then also right now there's this estimation of, well, where can I grab the highest yield? But when the Fed starts to cut this year, assuming they do, what part of the yield curve is going to give me the most appreciation, right? Because as interest rates go lower, then prices for those securities go up, if it's a fixed income instrument. And so we're seeing a lot of interest in the, I would say, call it the 2 to 6 year maturity band. So right now that would be 2026, to call it be 2029, 2030 maturities. Our view is that part of the curve will benefit the most from Fed rate cuts, and that it's less certain that we're actually going to see yields fall out in that 8 to 10 to 20 to 30 year part of the curve. So you may be picking up some more capital appreciation in what we call the belly of the curve, and so we like those intermediate maturities just from a tactical perspective regarding what might the yield curve do when the Fed starts to cut.
And high yield credit was one of the best performing subsectors within fixed income in 2023. Where do you see investors positioning for high yield bullet shares, and why do you believe high yield provides attractive value for investors seeking yield?
Sure. So it's interesting, last year, as you mentioned, high yield top performing sector in fixed income got hardly any flows because everyone was expecting a recession, and they don't like to buy high yield going into a recession when maybe credit spreads are going to blow out. And this year we've seen flows come back into high yield, this expectation that maybe we won't get a recession, or even if we do, probably won't be very severe. And those yields are attractive, 8-9% yields. We think that the trade isn't over. We're seeing a lot of interest in the 2025 and 2026 high yield maturities, especially the 25s. Essentially, you're getting a really high yield on paper that's about to mature in about a year or a little over a year on average. And the idea there is that even if the economy slows enough to enter a recession, those companies will still be solvent a year from now. If the recession were severe and long-lasting, maybe further out into the future, we might see a bigger default risk, across credit broadly. But the idea is that short duration high yield looks pretty attractive. Those bonds will probably mature before things get too rough.
Could you explain to us what reinvestment risk is and why bullet shares are a popular and effective vehicle to mitigate that risk?
Yeah, sure. So reinvestment risk is this idea that you buy a security with a certain interest rate today. When that security matures, you're going to have to reinvest that money at whatever that future interest rate environment is. And it may be an environment where you're going to get a lot less yield than you're getting today. So the idea is if I move out the curve and I buy something with a little bit longer maturity, it could be 2 years, it could be 10 years, but something with a longer maturity than a bank deposit, I can lock in that yield for that specific period of time. In between now and then, I'm not subject to reinvestment risk. The idea that I'm going to have to roll that whole investment in a different yield environment. And so bullet shares give you these very specific maturity bands that you can target. Again, it could be 2 years, it could be 10 years. You can essentially lock in that yield to maturity and know that between now and when those bonds mature, I'm not going to have to deal with rolling that investment in an uncertain environment. Eventually I will, but I can make that choice now and control that decision point.
Individual bond investing, it's been a staple for a number of years. And based on what you just said, it doesn't sound like it's an easy thing to do, right? So why has investing in bullet shares, how has it added efficiency for investors?
Sure, I mean, to your point, it is a well-worn strategy, but for a reason. Like, it works. Bond laddering, that is, buying a range of maturities so that in the future, you're never having to face that reinvestment risk all at one time. You've kind of hedged somewhat your risk regarding short-term movements in rates. So bond laddering and buying individual bonds and holding them to maturity. It's been done for 100 years or more. But buying one bond at a time in the over-the-counter market for an individual investor can be costly and time-consuming. And bullet shares essentially bring the technology of the ETF, immediate diversification, a very high degree of liquidity, intraday liquidity, right, and high degree of transparency at a very low cost, puts all of those things together, and then allows the investor to use good old-fashioned bond laddering in a far more efficient manner.
All right, Jason, appreciate the insight as always. Thanks for joining us on Trade Talks. And thanks for joining me from Exchange. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.